The Basel Accords. The Basel Accords, comprising of Basel 1, 2, and 3, are a series of advisory regulations set forth for financial institutions by the Basel Committee on Banking Supervision, or BCBS. Founded in 1974, BCBS was created as a forum to foster cooperation among member states on matters of banking regulation and supervision, aimed to enhance financial stability by improving supervisory know-how and the quality of banking supervision worldwide. In later years, it duly turned its attention to monitoring the capital adequacy of banks and banking systems of its member states. The Basel I Accord of 1988 set forth general rules of capital adequacy to ensure sufficient capital for unexpected losses. Introduced in 2004, Basel II served as an update to the original Basel I, focusing on three key areas of regulation: refining the definition of capital adequacy, improving the supervisory review of an institution's capital adequacy and internal risk assessments, identifying credit, market, and operational risks, and effective use of disclosure to strengthen market discipline and sound banking practices. Importantly, Basel II also refined credit risk measurement processes by outlining not only a standardized risk-based approach that uses external ratings to measure risk, but also a more tailor-made approach for banks to employ their own internal risk assessments. Only banks meeting strict disclosure requirements and permission from the national regulator are permitted to employ internal ratings-based approach to credit risk. Following Lehman's collapse, Basel III was introduced in 2010 to address the shortcomings of prior accords in addressing liquidity, leverage, funding, and systemic risk. It introduced stricter guidelines on capital adequacy, liquidity coverage ratios to ensure sufficient liquid assets to cover a short-term funding crisis, and overall leverage, calculated by dividing common equity Tier 1 and additional Tier 1 by total assets, not just risk assets.